Hello, my name is Monica Loeffler. I'm Head of Direct Finance at Charter Hall, and today I'm going to provide you with an overview of capital gains tax, also referred to as CGT. I'll discuss the two circumstances that CGT may arise, explain discounted capital gains tax, and provide an example of the impact of capital gains rollover relief in Diff 2. Please bear in mind that this is not intended to be tax advice, and your tax outcomes will depend on your individual circumstances. There are two circumstances when an investor may be subject to CGT. The first is when a property owned by the fund is sold. The second is triggered for the investor when a CGT event occurs in relation to the units the investor owns in the fund. It is important to note that the trigger for capital gains for both circumstances is aligned to asset and fund performance. For example, only if an asset is sold at a premium to its cost base will a capital gain occur. As the Charter Hall direct funds are treated as flow-through trusts for income tax purposes, the trust does not pay tax. However, investors pay tax on their share of the income distributed by the fund, and they pay tax based on their own personal marginal rate of tax. The components of income retain their character when distributed from the trust to investors. For example, capital gains incurred by the trust are treated as capital gains by the investor. Therefore, if an asset is sold at a premium to the cost base, the investor will realize a capital gain in that tax year. A capital gain is also realized by the investor on their investment in the trust in the event their units are redeemed or sold for an amount that exceeds the cost base of the investment. Depending on the investor's marginal tax rate and length of time the investment is held, the amount of tax that otherwise would have been paid if it was taxed as income in the year of receipt may be reduced. For example, if the units have been held by the investor for more than 12 months, the capital gain will be assessed at the discounted capital gains tax rate. For individual taxpayers, this equates to a 50% discount, meaning only 50% of the gain is taxable at their marginal tax rate. Superannuation funds are entitled to a 33% discount. For superannuation funds in the allocated pension phase, the capital gain may be tax-free, even if the investment was made prior to the allocated pension phase. Now, I will walk you through an example of capital gains in Diff 2 and the impact of electing Diff 4 scrip instead of cash. In this case, the Diff 2 investor is benefiting from CGT rollover relief. As per the ATO class ruling received by Diff 2, investors can elect CGT rollover if they have elected to receive Diff 4 units as consideration for their Diff 2 units rather than cash. This means that CGT is not triggered at the time the Diff 2 units are transferred into Diff 4 units, but is deferred until a CGT event occurs with respect to the Diff 4 units. The investor's cost base of the Diff 2 investment will become the cost base of their Diff 4 investment. The example I will discuss now is based on an Australian investor that holds Diff 2 wholesale units on capital account, acquired in December 2012 with no further applications or redemptions. Assuming $100,000 was invested in December 2012 for 100,000 Diff 2 wholesale units, and were held on capital account, the initial cost base is $100,000. To date, Diff 2 has distributed approximately $137,000, which includes special distributions following the sale of Diff 2 assets. Of these distributions, $65,000 was tax-deferred income. As the tax-deferred income reduces the investor's cost base, the cost base in this example would be $35,000. If this investor elects to receive Diff 4 units as consideration, their aggregate cost base in Diff 4 units would be $35,000, and no capital gain would be triggered until the Diff 4 units are redeemed or sold, or the remaining cost base is fully utilized. For investors that elect to receive a cash payment for their Diff 2 units, assuming an estimated cash consideration of $1.66 per wholesale unit, a capital gain of $131,000 will be triggered. As discussed previously, depending on the investor's marginal tax rate and length of time the investment is held, the capital gain may be taxed at a discounted rate. Please note this example is an estimate based on a hypothetical investor who acquired wholesale units at a point in time, and therefore will not apply to all investors in Diff 2 and is subject to change. In summary, an investor may pay capital gains at the time the fund sells a property, which may be prior to the investor redeeming or selling their investment due to the flow-through nature of the Charter Hall direct funds. At the time the investment is redeemed or sold, a capital gain may also be triggered for the investor if the total tax-deferred distributions exceed the cost base. Under these scenarios, and depending on the investor's circumstances and time the investment has been held, a discounted rate may apply. It is important to note that capital gains are only triggered when the asset or investment are providing returns greater than its cost base. Thank you for joining me for our bite-sized learning on capital gains tax. I hope you found this informative.